Stop everything you're doing right now. Close every other tab, put down your phone or your notebook, and listen carefully. If you don't understand the magnitude of what just transpired while the Western financial world was asleep, you're about to be left behind by one of the fastest and most consequential shifts in global wealth and power in modern financial history. This isn't hyperbole, it isn't speculation, it's real. It's happening right now in real time, and you need to know exactly what's unfolding so you can understand not just the direction of the markets, but the forces driving them, geopolitical, economic, and strategic forces that are rewriting the rules of finance. It is Tuesday, January 6th, 2026, a day that will be recorded in financial history as the moment the silver market broke, the moment China effectively took control of a strategic resource, and the moment the United States banking system quietly raised the white flag in what can only be described as an economic surrender. Yesterday, Monday, January 5th, the New York trading session closed with silver near $75 per ounce, already an extraordinary level. That rally had been driven by geopolitical tensions, safe haven demand tied to the crisis in Venezuela, macro volatility, and the classic flight to real assets. Western traders shrugged after the close, bankers tallied their books, analysts scribbled overnight scenarios, and the U.S. financial complex acted convinced it could regroup and mount a defense on Tuesday morning. But they forgot something fundamental. They forgot that when New York sleeps, Shanghai wakes up. They forgot that the global center of financial gravity has shifted. They forgot that they were no longer facing retail traders, hedge funds, or Western institutions. They were facing the industrial capital of the world's second largest economy. And last night, while the American banking system was dark and silent, China launched an assault on the silver market so massive, so coordinated, so relentless, that it has fundamentally changed the balance of power in precious metals forever. When the Asian trading session opened, silver began trading at $75. Within hours, it climbed to $76, then $77, then $78. And by the time the Shanghai session closed this morning, silver was trading at $79 per ounce, a $4 rise in a single overnight session. In any normal market, a $4 move in a day would be notable. In the typically slow, methodical world of precious metals, that's an earthquake. But this isn't normal price action. We already saw a massive spike from $71 to $75 just 24 hours earlier. That means silver has now seen two historic spikes in back-to-back sessions, an extraordinary disruption. Make no mistake, this is not retail speculation. This is not technical trading. This is economic war. And China just deployed what can only be described as the strategic equivalent of a nuclear strike on the silver market. The data coming out of Shanghai is nothing short of staggering. Preliminary order flow analysis shows that approximately $8 to $10 billion in fresh capital poured into the silver market during the Asian session. Let that number sink in. $7, $8, $9, $10 billion. Chasing a market that produces roughly $2 billion worth of silver globally in an entire year. Do you understand the math of what that means? China attempted to absorb nearly half of the planet's annual silver production in a single trading session. That level of buying pressure is not a trade. It's a strategic accumulation. It's a nation saying in no uncertain terms, we don't care about price. We don't care about resistance levels or technical charts. We are taking the metal, all of it, and you can either sell to us now or sell to us at twice the price tomorrow. Here's what is absolutely critical for you to understand. The U.S. banking sector saw this happen in real time. Their overnight desks were monitoring the Asian market. They saw the price action. They saw the volume. They saw the relentless buying that ignored every conventional measure of overbought conditions. And they made a decision. They stopped selling. The same banks, JP Morgan, HSBC, Deutsche Bank, and others, that have spent decades suppressing the price of silver through coordinated shorting, through selling into rallies, through capping breakouts, have now stopped. They pulled their sell orders and stepped aside because they finally grasped something that should have been obvious months ago. They cannot win this fight. Not against this scale of capital. Not against a sovereign actor with trillions in foreign reserves and a long-term strategic accumulation plan. When you're fighting retail investors, you can influence the market. You can adjust margin requirements. You can issue bearish research. You can coordinate selling with other institutions and temporarily cap a rally. Retail traders have limited capital, limited conviction, and limited staying power. But when you're fighting a nation-state with access to $3 trillion in reserves, coordinated order flow, and strategic imperative, you cannot outlast them. You cannot manipulate them. All you can do is get out of the way or get run over, and the banks chose the former. Institutional sources now confirm that major bullion banks, the very same institutions that have remained net short silver for years, are losing hundreds of millions in the last 48 hours. Positions that were established at $50, $60, or $65 per ounce are now deeply underwater at $79, and losses are compounding with every hour the price remains elevated. But more importantly than the money they are losing, they've lost something much more valuable. They've lost control of the narrative, price discovery, and the market itself. For decades, New York was the global price setter for silver. London, Tokyo, Shanghai, all of them followed New York. But that era ended last night. Shanghai is now setting the price. Shanghai just declared silver to be worth $79. When New York opens today, traders will have two choices. Accept that as the price of record, or watch every ounce of physical silver in Western vaults be arbitraged to China. Let's talk about how that arbitrage works and why it is terrifying for the Western financial system. When New York closed at $75 and Shanghai reopened at $79, that created a $4 per ounce arbitrage spread. On a commodity that trades in 1,000-ounce bars, that's $4,000 per bar in risk-free profit for anyone able to source physical silver in the US and ship it to Asia, legally and physically. And that is exactly what's happening right now. Traders are calling dealers and refiners in the United States. They are offering premium prices for immediate delivery. They're chartering private jets and cargo flights to move metal across the Pacific. They're buying American Silver Eagles, Canadian Maple Leafs, kilobars, anything they can find. Because at a $4 spread, you can absorb massive premiums, pay for expedited shipping, pay collectors or brokers whatever it takes, and still make profitable arbitrage trades. The arbitrage machine right now is acting like a financial vacuum cleaner, sucking physical silver out of the United States at a mathematically unsustainable pace. Registered COMEX inventory, the metal available for immediate delivery, dropped another 2.1 million ounces yesterday alone. At this rate, the registered category will be empty by the end of January. Not months from now, not sometime in the spring, but within 3 weeks. And when COMEX registered inventory hits zero, the exchange will have no choice but to implement force majeure. They will have to admit they cannot fulfill delivery requests. They will be forced to cash settle contracts. And when that happens, confidence in the paper price collapses instantaneously. The only price that will matter will be the physical price, which is now being dictated by Shanghai and China. At this point, some of you might be thinking, but can't the banks just short the market again? Dump futures contracts like they always have and push the price back down? That strategy is now dead. Here's why. When banks try to short now, China just buys every contract. They don't care about technical indicators. They don't care about RSI or MACD. They care about gaining ounces. They will buy every sold contract, stand for delivery, and demand physical silver. If the banks refuse delivery, they default, triggering a cascade of systemic consequences. The banks are trapped. If they short, China buys and demands physical delivery. If they do not short, prices continue to rise, and their existing short positions bleed them dry. It's a no-win scenario for the holders of those short positions. That's why several major banks have already covered large parts of their short books, crystallizing steep losses by buying back at prices far above where they originally sold. Their exit buying is unintentionally fueling the rally. But let's look at the price action, because what the charts are showing is extraordinary. Yesterday, silver punched through the psychological resistance near $75. That breakout was significant. But instead of pausing or consolidating overnight, the market immediately accelerated higher. We saw them at $76, $77, $78, and finally $79. The price action is near vertical, a classic hallmark of a short squeeze and seller capitulation. And the volume tells the real story. Normal overnight trading might see thousands of contracts change hands. Last night, we saw tens of thousands. Volume up 400%, 500%, even 600% compared to a typical Asian session. This is not retail speculation. This is institution-level money. This is sovereign accumulation. This is China telling the market, we are here, we are buying, and we are not stopping. Now, when New York opens later today, traders will arrive at their desks, log in, and face a stark reality. They no longer control this market. Shanghai does. If they accept that and open the session at or near $79, we'll see a brief consolidation as people digest the overnight action. The price may hold between $78 and $80 for a time, as traders reprice risk and position for the next leg. But if they attempt to defend the old regime, if they open at $75 and ignore Shanghai's price, the arbitrage engines will engage, and every ounce of physical silver in U.S. vaults will flow to Asia within hours. In that scenario, we could see emergency measures, trading halts, margin requirement changes, position limits, but none of them work in a world where China is demanding physical delivery. You cannot suppress the price with paper contracts when a sovereign actor is taking delivery at scale. Supply and demand eventually assert themselves. And right now, demand is overwhelming supply. Let's put some real numbers behind this. Worldwide annual silver mine production is around 800 million ounces, roughly 65 million ounces per month, or about 15 million ounces per week. China's overnight buying, based on $10 billion deployed at $79 per ounce, implies demand for approximately 125 million ounces in a single session. That is more than 8 times the weekly global supply. That imbalance cannot be sustained without dramatic price increases. Now, I am not predicting silver hits $650 this week. That would be absurd in the short term. But what I am saying is this. At $79, the price is still wildly below where it needs to be to rationalize physical supply with physical demand. And because of that, the path of least resistance is up, significantly up. China knows this. They've done the math. They know at today's price they are still buying far below where physical scarcity forces the market to price the metal. And this is not a short-term tactical trade. This is a strategic accumulation that will last months and years. They know that in 6 months or a year, when shortages become undeniable, silver will likely trade at multiples of today's price. $150, $200, $300. These numbers are not outlandish if the physical market disconnects from paper. So China is buying now, before that reality becomes obvious to everyone else. But let's address the question of whether we have hit a top or whether this is a temporary spike. Many of you may be thinking, we've already gone from $71 to $79 in 2 days. Isn't that enough? Should I take profits? Should I sell? If you're trading futures or using leverage, you absolutely need to consider risk management. Volatility over the next few weeks will be extreme. We could see meaningful pullbacks as margin requirements shift, algorithms react, or the banks make one last coordinated technical attack. A correction back to 73, 75, or 70 is highly likely and healthy from a technical perspective. But if you are holding physical silver, coins, and bars that you own outright, selling now would be a mistake. This is not the end of the rally. This is the beginning. We are barely in the awareness phase. The mainstream media has not yet caught up. CNBC is not shouting about this from the rooftops. Most investors still have no idea what is unfolding. This phase is institutional accumulation. The retail euphoria has not even started. One of the clearest technical signals that we are still early is the gold to silver ratio. With gold near $20,900 and silver at $79, the ratio sits around 36.1. Historically, during major silver bull markets, this ratio compresses to 30.1, 20.1, or even lower. That means silver still has significant relative upside compared to gold. $120 silver with gold at $3,000 would bring the ratio down to 25.1, which is still well within historical norms for bull markets. Markets do not move in straight lines. Corrections are necessary. The current rally from $71 to $79 has gone straight up with virtually no pullback. That is not sustainable. Price needs to breathe, retest, and shake out weak hands. When you see silver drop from $79 to $72 or $70, the mainstream media will declare the rally dead. Analysts will say the bubble popped. Retail traders will panic. They will sell. But that will be exactly the moment the smart money and sovereign buyers step in again. That correction will likely be engineered in part by stop-loss clusters sitting just below major levels like $75 and $74. When those stops get triggered, the market makers will get the liquidity they want, and then China will mop up the discounted metal again, driving prices right back to and above prior highs. That's how wealth moves from the emotional and leverage to the patient and physical holders. So what comes next? The next major technical target on the silver chart is $84 per ounce, the all-time high set in late 2025. That level represents significant resistance because it is where many sellers who bought near those levels in the past are still sitting, waiting to break even. But based on current momentum, volume, and strategic buying, a move to $84 is not only likely, it's imminent. It could happen within days. And once that level is convincingly broken, especially on high institutional volume, markets will enter true price discovery. There is very little resistance between $84 and $100. Once the algos and trend funds recognize a confirmed breakout, silver could surge to $90, $95, and beyond in rapid succession. Volume will be the key confirmation. A breakout on strong institutional buying, especially Chinese accumulation, will validate the move. A breakout on thin overnight volume may be a false signal. Now, let's widen the lens, because silver does not move in isolation. Gold is participating in this rally too. Gold recently hit a new all-time high, touching $20,900 per ounce. That's significant because when both gold and silver rise together, it confirms that this is not just a metals rally tied to industrial demand, it's a monetary crisis rally. Investors are seeking safety from fiat currency pressure, geopolitical tension, and financial instability. Platinum, a metal deeply integrated with industrial demand, is also waking up. After years of underperformance, platinum has surged from $950 to over $1,020, about a 7% move. That suggests that industrial demand remains robust, that this rally is not driven solely by fear, but by real tightening in physical supply across the industrial metals complex. Mining equities are also exploding. Silver mining indices have jumped more than 15% in 2 days, and individual producers like First Majestic, Mag Silver, and Hecla Mining are seeing 20% to 40% intraday spikes. Mining stocks offer leverage. When silver moves 10%, miners often move 30%, but they also carry volatility and risk. They are trading vehicles, not buy and hold physical assets. Now let's confront the skepticism that many of you are thinking right now. Everyone's been calling a silver squeeze for years and it never happens. Why is this time different? The answer is simple and profound. This time the driver is not retail traders. This time the driver is a nation state with strategic intent, nearly unlimited capital, and a long-term accumulation plan. China is not buying silver because Reddit told them to. China is not buying because of a meme or short squeeze play. China is buying because silver is a strategic resource, critical to industrial technology, energy transition metals, and monetary hedging in a world of weakening fiat currencies. China has done this before with other metals: copper, lithium, cobalt, and rare earth elements, cornering supply chains essential to future technologies. This is not a pump and dump. This is a multi-year strategic initiative with geopolitical intent, and the United States cannot stop it. To stop China's accumulation, the US would have to either flood the market with silver to meet Chinese demand and collapse the price, or implement export controls to prevent silver from leaving the country. The first option is impossible because there is no excess supply to flood the market with. Strategic stockpiles are depleted, COMEX inventories are draining, mining cannot increase production overnight. The second option is politically and economically untenable. Export controls would signal weakness, undermine confidence in free markets, and likely accelerate the panic they intend to prevent. So the US is effectively powerless to stop what is happening. What we are witnessing is not just a market move. It is the end of the unipolar financial era and a shift toward a multipolar world where hard assets matter more than paper derivatives and where physical commodities determine strategic leverage. Silver is the canary in the coal mine. It may be the first domino to fall, but it will not be the last. If China successfully corners silver, it will target other strategic materials: copper, nickel, lithium, cobalt, rare earths, and use trade surpluses and industrial strength to acquire control of the physical resources needed for the 21st century. And the West will be left holding paper claims on assets that no longer exist. This is the greatest wealth transfer in history. From West to East, from fiat to physical assets, from financial promises to real tangible resources. And it's happening right now in real time, while most people remain oblivious. So what do you do in the next 48 hours? Here's your action plan. First, if you do not yet own physical silver, fix that immediately. Contact reputable dealers, SD Bullion, APMEX, JM Bullion, and buy whatever you can afford. Yes, premiums are high. Yes, you'll pay above spot, but that premium is nothing compared to where prices may go. Second, if you are holding paper silver, ETFs like SLV, futures contracts, understand the counterparty risk. Paper claims may become worthless or cash settled at unfavorable prices when COMEX can no longer deliver physical metal. Convert paper to physical as soon as possible. Third, watch the $75 level closely. If we see a pullback into that range, be ready to buy the dip. Those opportunities may be brief, and China will likely buy them faster than any other participants. Fourth, ignore the mainstream media noise. Analysts who call rallies over because of old technical models are not accounting for sovereign accumulation, strategic intent, or physical scarcity. Fifth, have an exit strategy. Physical silver is a store of value, not a dollar income generator. Consider trading or swapping into gold when the gold to silver ratio compresses toward 30.1 or better. This moment is rare. It may only come once or twice in a lifetime. It's the opportunity to be on the profitable side of a historic shift, the turn from paper claims to real physical assets. 6 months from now, when silver is trading at $150 or higher and you cannot find it at any price, you will wish you had taken action today. The war is here. China has declared economic war on the Western financial system, and their weapon of choice is silver. They are buying it all. They are draining the vaults. They are taking control of the price, and the U.S. banking system has surrendered. The question is not whether this will continue. The question is, are you on the winning side, or still holding paper promises in a world that is rapidly becoming physical? This isn't fear-mongering. This is documented reality. The Shanghai price closed at $79. COMEX is playing catch-up. Arbitrage is sucking inventory out of the West. Registered stocks will hit zero within weeks. The silver market just broke. China is in control. And the greatest wealth transfer in modern financial history is underway.